So what I want to look at now is the last two learning objectives for today's workshop. The first one relates to closing entries. So we're going to look at the purpose of closing entries and how you record them. Right, now remember, we want to track performance over a particular period of time, and that relates to the revenues we're earning, the expenses we're incurring, and also the dividends that we are issuing to our shareholders. We want to look at those levels of activity during the period. So what we need to do is we need to close all our accounts after we've recorded our adjusting entries and generate our financial statements, so we can then track the performance for the following period. And this relates very much to any sort of performance measurement. So for example, if I show you a stopwatch here, so what happens at the end of the race? Well, we click the stop button, we record the time, we reset it back to 0. So athletes get very upset if we just kept the stopwatch running while they then ran their next race, because of course we wouldn't be capturing the finite period of time that their performance related to. So we want to do the same thing from an organizational perspective. So if the organization has a 1-year annual financial period, then what we're doing there is we want to measure performance only for that year and then clear out all the relevant performance related accounts at the very end of that period so we can measure performance again for the following period. So what we want to do is we want to clear out all our revenue accounts. We want to reduce them to 0 after we've put together the financial statements at the end of that period. We want to clear out all the expense accounts, and we want to clear out all the drawing accounts. So for example, the accounts that relate to dividends. So how do we actually do it? Well, this is the closing process. So the box that I have here, so the numbers and the accounts, which this box is around, relates to the accounts that we want to close off and 0 out so we can start counting again for the following period. So notice there that service revenue has a balance of $8,500 at the end of the period, and we have all these expense accounts and the dividend account down the bottom here. How do you clear them out? Well, of course, if you have a service revenue account of $8,500 credit, then of course to clear it to 0, you debit it by the same amount. That then makes that account 8,500 credit to a 0 balance. And you do the same thing with your expense accounts. You credit them by the same amount as the ending balance. Now, where does this amount go? Because you know the accounting equation always needs to balance. So you can't just debit and credit particular accounts and then do nothing on the other side, because our accounting equation will be out of balance. So we can't have that. So the amounts get transferred to retained earnings. So remember I said at the very end of the accounting process, you look at the retained earnings account and you use it once. And this is the only time you ever use it, which is during the closing process. So what you do here with service revenue is you debit it, as I said, to clear it out, and you transfer that amount by crediting that amount to retained earnings. You do the same thing with expenses. So you credit all the expense accounts to wipe them out, and you transfer those amounts to the retained earnings account. And lastly, you do the same thing with dividends. So if you have a debit balance of dividends here of $1,500, you credit dividends by that amount and you transfer it to retained earnings. So therefore, the change in the retained earnings balance at the very end of the period when you record these closing entries is equivalent to the profits you've generated for the period minus the dividends or drawings that you have issued to shareholders. That's why we call it retained earnings, because it is profit that is kept on hand and undistributed to the owners. So that's the very last thing you do at the end of the financial period. Now, to summarize the accounting cycle. What is the accounting cycle? Well, it's everything that we have done over the last 2 weeks of workshop. So last week's workshop and this week's workshop, right? So a summary of it is essentially summarized in this slide here. So the first thing we do throughout the period is we journalize the transactions and we post these transactions to the different T accounts that you draw up for every single account. You prepare a trial balance, and then after you prepare that trial balance at the end of the financial period, you then need to record the adjustments. So that's everything that we looked at today. You record the adjustments to recognize your revenues and expenses that you have earned and incurred for the period. You prepare an adjusted trial balance, which is obviously the adjusted one, and then you can prepare your final financial statements. Those financial statements are then reported in, say, an annual report for Commonwealth Bank or BHP or Woolworths or Wesfarmers. After you've done that, you've basically reported on the financial performance and position for the period, so you can close all the accounts that track performance, so your revenues, your expenses, and your drawings, and you can prepare a post-closing trial balance, which essentially shows what all your assets, liabilities, and equity accounts are, and shows zero for your revenue, expenses, and drawings account. So again, those accounts that track performance over time.